Hello, everyone, and welcome to the next episode of Meet the Investor. Joining us today is Candace Myung, Managing Director for Oaktree Special Situations Group. Oaktree is a leading global alternative asset manager with 224 billion US dollars of assets under management. Thank you for joining us today, Candace.
Hi, thank you for having me. Really glad to be here speaking to an Australian audience. And of course, we have a Sydney office and many Australian investments as well. So thank you for having me.
Right. If you could start maybe with just telling us a little bit about yourself.
Sure, of course. As you pointed out, I'm an MD at Oaktree in the Special Situations Group. Been with Oaktree for about 8 years now. And before that, I spent about a decade in investment banking, focusing in leverage finance. Spent a couple of years in tech on the strategic finance team. And when I think about my journey to Oaktree, I mean, in banking and finance, Oaktree had always been a destination of choice for us investment bankers who knew anything about credit and distressed investing. So when I had the opportunity to join the organization, to join the firm, I definitely took it, especially given that Oaktree is headquartered in Los Angeles, and I lived in Los Angeles. I went to UCLA for business school, so uh, get to stay home, which is nice.
Um, and for many of us in the industry, Oaktree is a huge global brand name. But for those less familiar, can you tell us a little bit about the history of Oaktree and what their special investment areas are?
Yeah, absolutely. So Oaktree was founded in 95. It was founded by Howard Marks and Bruce Karsh. Many of you have probably heard a lot about Howard Marks. He's very famous for his investor memos. So we do have a finance celebrity on the team. 220 plus a billion dollars of AUM, and this spans credit, equity, and real assets. Importantly, our start and the biggest portion of our AUM is credit and distressed investing, and that's uh, effectively how we got started. But we're pretty diversified. Importantly, we have an investment philosophy that has 6 tenets that really govern how all of our 20 plus unique and distinct investment strategies invest. The important piece here is we are focused on a risk control approach to investing, meaning we are value driven. We focus on capital preservation, and that is the first tenet of our investment philosophy. I won't bore you with kind of all six, but the second piece is consistency of returns. We're not trying to hit grand slams. We're not trying to swing for the fences for every single investment. And then sometimes you'll have huge losses. Sometimes you'll have big gains. We're really trying to hit singles, doubles, triples consistently for all of our investments. And that really summarizes a lot of what we do. We like to invest where people don't. We like to take a contrarian approach. We look into complex situations, across the board.
And today we're here to focus on special situations, which is your area of expertise. Can you tell
Uh,
us what special situations investing is?
yeah, of course. Maybe just taking a step back. The special situation strategy is one of Oaktree's original 5 strategies. So, as I mentioned before, Oaktree was kind of born as a distressed debt investor. And we were a step out of our flagship distressed debt strategy, the OPS funds, the opportunities funds. The special situation strategy has really evolved from those old roots of distressed investing to what it is today, which is at its core a deep value, middle market private equity strategy with the ability to flex between credit and equity. And that deep flexibility to focus on special situations really makes us all weather. Now, what is a special situation? That's the most important question. We define that as some kind of business or asset that, for one reason or another, can't or is unwilling to access traditional capital markets. And it could be a business that is facing some kind of company specific or idiosyncratic challenge. So think like a disgruntled minority shareholder, or maybe they have some kind of operational hiccup. They lost a big customer relationship for something unrelated or maybe related to that current management team. And that's idiosyncratic. It also spans the spectrum of healthy, growing businesses, but there's something very unique or specific going on that precludes it from selling it at a full market multiple. And then, of course, we can also take advantage of macro distress. A special situation could arise because of broad market distress, like think the COVID-19 pandemic when the world shut down. Importantly, while that's how we define special situation, we do want to point out that we focus on businesses that have a reason to exist. So it's not just let's invest and find and exploit special situations, but these businesses need to have some kind of leading market position. They have a product that's critical. And I think Howard put it best. If we avoid the losers, the winner will take care of themselves. So we're looking for businesses that we can help make better.
And the strategy has three key pillars of investing within special situations. Can you explain each pillar in layman's terms and what they're designed to achieve?
Of course, of course. So when I take a step back, you look at our three arrows in the quiver, and they're really what we would consider tools in our toolbox that allow us to exploit special situations and again, all market environments. It's really the hallmark of our strategy. So, you think of when you think of tools in your toolbox, sometimes a screwdriver is the right tool. Sometimes it's a hammer. Sometimes it's a wrench. Some cases you need two of the three, or they work interchangeably, right? And these tools are really the investment types by which we structure and access these special situations opportunities. So what are they? They're distressed debt, structured equity, and direct equity. I'm going to start with distressed debt since that was, our original mandate, which we've evolved quite a bit since then. Distressed debt, also known as distress for control, is where you have a financially distressed business. Oftentimes that business is over-levered and it cannot make its debt payments. What happens is that business's debt trades down in the public markets. So usually, somewhere between, let's call it 20 to 60 cents on the dollar, which implies that the debt is that debt won't be repaid in full. We purchase that debt on the secondary market, and we build a very large strategic position in that security. Then we will lead the restructuring efforts, and in a restructuring process, we'll end up owning the equity of the business, a controlling stake in that business via the restructuring in a debt for equity swap. It's a very cheap way to own a business, but we recognize that this type of investment opportunity is not available to us in all market environments. If you look at pre-pandemic, we were in a 10 plus year bull market. There are very little pockets of dislocation where lots of debt traded down. And so while it's a great way to access, value-driven opportunities, it's hard to deploy just a large fund based on this singular strategy. What we do most of the time now is actually called structured equity. And this is what I would call, you can call it synthetic distressed debt, but really it's investing via a fixed income format. So a fixed income security where there is a coupon associated with it and significant equity upside. So for example, we can invest in a business via preferred equity. And let's say it comes with a 10% PIK coupon, plus that preferred equity is convertible into 30 or 40% of the common equity of the business. It could also take the form of a second lien term loan with like a 15, 17% high octane interest rate plus warrants. And it could also take the form of a control investment. It could be a 8% convertible preferred equity instrument that converts into 60% of the common equity of the business. So we control that business up front.
So that's just to break that one down a little bit. There's a few examples given in terms of the type of structured equity, but it's effectively almost a customizable term which starts with some level of debt type structuring where you're getting either a fixed interest paid as a coupon or payment in kind, which means that they roll the interest and capitalize it to be paid at the end, and then with some sort of terms where it converts into equity. Is that effectively what we're saying for that?
That's exactly right. And it could be a conversion feature or it could be warrants. But the reason why we call it structured equity is because there's there's structure, meaning there's some kind of, usually a maturity or a state of maturity or a put right. There is some fixed income component, right? Somewhere between, let's call it 10 and 15%. And importantly, it's structurally senior to some junior portion of capital. So oftentimes will be preferred equity, and there'll be a pretty significant amount of common equity behind us, which gives us meaningful downside protection, added cushion, right?
Okay.
And that's why we call it, again, structured equity. But it could be both control and minority deals. And in the case of minority deals, there's a lot of protections that we put there to ensure we can, one, take over the business if it's not going our way and hire and fire management, and two, make sure that we control our exit.
Okay. So that's distressed debt and structured equity. And the third pillar?
The third is direct equity. It's kind of a catch-all for everything else. It's the smallest part of our business currently. This is more what you would think of your traditional LBO style investing, but the way that we do it, it's typically distressed M&A. So you just buy a business outright when the price is right for us, or oftentimes it looks like a platform investing, like a roll-up strategy, where you buy smaller assets, you roll them up into a larger consolidated platform, you turn it into a professionalized business, and then you sell it for a premium.
Okay, so more typical private equity style investing there.
That's right. But again, very disciplined focus on the value up front.
Okay. And just to bring those structures to life, I know we spoke about some of the sort of typical terms. Do you have examples that you could talk to help everyone understand what exactly you're doing there?
Of course. I think let's start with structured equity, because I think this is, it's typically a creative, bespoke structure. It's very company specific. We had a recent deal that we just exited out of our latest fund, or our most recent investing fund, back in 2025. And this was a consumer products business. They were a market leader in their category. They sold through big retailers like Walmart, Costco, and they also had a direct consumer channel. So we were originally introduced to this company back in the 2021 timeframe. If you recall, SPACs were all the rage, and the company's original advisor had reached out to us to provide a backstop for its contemplated SPAC transaction. So if you recall, in terms of how the SPAC market works, usually you had backstop financing to protect against redemptions should the market not like the company that's being SPAC'd, de-SPAC that is. Long story short, we don't do that type of passive. We don't provide that type of passive capital. But we did see the cracks in the SPAC market, and we love the business. So we built a relationship with the company's founder, and we said, "Hey, the SPAC market falls apart. Let's keep in touch. We can potentially provide you a better private solution." Fast forward to 2022, the SPAC market fell apart. And at that point, the founder was fatigued. He had the reason why he wanted the money in the first place is because his business was funded with growth capital from one of his co-manufacturers, a sole source co-manufacturer. And that sole source co-manufacturer was located overseas, was not, a natural owner of the business. And he had negotiated with that co-manufacturer to buy him out at a pretty favorable valuation relative to where he thought he could grow the business. So what we did is we worked with him. We're like, okay, let's first buy out your first lien debt holder. It was very expensive paper, and we wanted to minimize the risk in front of us. And then we'll invest via a convertible preferred security for you to buy out that minority shareholder. So what did our investment look like, right? Our investment looked like about a $50 million term loan, first lien term loan, which we call a $1 attach, no leverage in front of us, that had a S plus 7.5% interest rate and some fees. So think of this, back in 2022, that's like a 14, 15% interest rate. We also invested about $100 million in a convertible preferred or convertible note. And this was convertible into about a third of the common equity of the business. This also had a 14% coupon. So a very expensive PIK paper. And that we use a term called creation value, meaning it's a detachment point what is the valuation at which we would break even on our investment. So if you combined our $150+ million that we invested in the business, the creation value was 2.5 times, meaning if we sold the business the next day for 2.5 times that EBITDA level, we would break even. So we loved the downside protection of it. Fast forward to 2025, we inserted our operations team to work very closely with the founder, the management team, and we grew EBITDA 2.5 times from our original investment. We ended up selling that business to a strategic and making a very nice return. But more importantly, it highlights how we were able to partner with, the existing management team. This is a completely healthy business with no distress. But again, there was a special situation that was very, very company specific. And we were able to come out with a very nice outcome and what I would define as a private equity-like return.
Great. Do you have an example in distressed debt?
Yeah, I was gonna say I could do distressed debt, and maybe this will. Hopefully, I don't give up too much about who the company is, but it's going to be an Aussie company. This is going to be our most recent distress for control transaction that we've done. But this is, let's call it a global healthcare business, right? It was a market leader in several geographies globally, and this was sponsor backed. So for
Sponsor backed meaning it was owned by private equity.
Yeah, that's right. It was owned by private equity, and they had really grown it to a really good business. But what happened was they made a mistake and they acquired a business. It was a fully debt financed acquisition, very, very large acquisition, several years ago. And the integration went poorly. COVID affected it. There were some other operational missteps in between. And long story short, the company faced meaningful liquidity issues. So our Aussie team, our Sydney team, they began looking into the business and diligencing this business to 2021, 2022, and actually proposed a structured equity solution to help give the company liquidity to fight off a potential bankruptcy. The sponsor at that time decided not to go with our solution. And you fast forward a couple of years later, and the company was on the brink of bankruptcy. We'd already developed a relationship with the management team. We already did all of our due diligence. So basically, the week or two before their Chapter 11 filing, we were able to acquire $250 million face value of the company's senior secured debt at roughly 25 cents on the dollar. We became the largest lender. We formed what you call an ad hoc group, which is we formed a consortium of the 4 largest lenders and led the restructuring. This consortium also provided new financing in the form of a DIP facility to help keep the lights on for this, very important critical healthcare business during its bankruptcy process. And then ultimately post-bankruptcy, post-emergence, we are now the largest equity holder in the business. We own about 25% of the common equity. The doctors and the employees are much happier because obviously the business isn't distressed. The business is meaningfully outperforming the forecast that we put together as a part of its bankruptcy process. And if I remember, I mentioned there was an acquisition that didn't quite go right, which is the catalyst for all of this distress. We were able to ring fence that asset as a part of the bankruptcy process and then sell that asset. So if you look at the overall investment, we refinanced a lot of that post-emergence, that post-restructuring debt. And we have a lot of equity upside to go. So we're very, very happy with how that business is going. And so we've had a lot of strategic and sponsor interest in the remaining assets that we own.
And that example brings me to my next question, which is trying to find the balance between something that's a good deal for the borrower, where it doesn't sort of cripple their business by being too expensive, distressed debt offer or a structured equity offer, whilst also balancing the fact that you want to generate good returns for your investors. How do you find the sweet spot between those two things?
Yeah, I mean, that is a very, very good question because we know right off the bat that we are expensive paper, right? 15% paper is expensive. And so we know this Oaktree Special Situations Group is not your first phone call when you have a capital need. We know that. But then why does a borrower why does a borrower pay for us? Sometimes it's a house on fire situation. Sometimes they have no choice and they need certainty and speed of capital, right? So that's one option, right? More importantly, and more often than not, um, it's because these companies, our portfolio companies, they understand that we're not just passive capital. We bring a financial and operational solution. So maybe going back to my original example, that structured equity example. Yes, we could provide capital, but we have a group of 6 individuals, very senior individuals, called the Portfolio Transformation Team. These are ex blue chip consultants, McKinsey, BCG. They have true C-level operating expertise at real companies. So when we tell a founder, like, hey, you don't have to work 60, 70 hours a week anymore. You can take some chips off the table today. Let our team come in, help drive the growth of that business, and then you can also take advantage of the upside by retaining some minority position. And that's a pretty compelling argument. A lot of our competitors. So if you look at the traditional private credit guys, they don't have that operational expertise. And then if you look at who we compete on the traditional private equity side, they want 100% of the common equity. If they're going to roll up their sleeves and do the operational work, they want 100% of the upside. We can use structure to our advantage where we don't need 100% of the equity. We will sacrifice that, or we will instead sacrifice that for downside protection, and it will still do all of that heavy operational lifting.
And within a private wealth portfolio, where do you see these kind of opportunistic strategies sitting? You mentioned that this is a bit of a bridge between private equity and private credit, sort of private equity like returns, private credit type risk, if you like.
Yes.
Where would this sit in a portfolio?
I mean, that's a really good question. I mean, that is a very, very common question we get from our investors, because it really, really depends on our investor's portfolio, right? You have to think about, first of all, should we fit into your private equity book? If so, why? So first, does your private equity book have a lot of growth equity, VC? Is it a high beta portfolio and you need to hedge some of that risk? Then we would be a great complement to that portfolio, because one, we try to drive private equity returns, but by taking credit-like risk. And how do we measure risk? With lower loss ratios. To us, that means sub 5%. You know that when private equity is in distress, you know that when they're not deploying capital, when rates are high, when M&A is low, when there potentially is a big, broad dislocation, that is when Oaktree Special Situation is going to find the most investment opportunities and accelerate our pace of deployment. So that's kind of one way to look at it. The vast majority of our investments take the form of preferred equity or debt. And so structurally, from a security perspective, we're a good fit, especially when you look at our loss ratios. And then we can help enhance the returns of that book. And then probably the easiest fit is if you have like a distressed or alternatives or special situations type of bucket. We're probably best suited for that type of bucket, but not many investors have that.
And to round it off, if listeners were to remember just one thing about special situations investing in today's environment, what would that be?
Just one thing. I guess what I want folks to remember is special situations investing doesn't have to be distressed investing. You don't have to try and time the cycle. Oaktree's version of special situations investing is intended to be all weather, where we can drive private equity returns by taking credit risk because of the flexibility that we have, because we have restructuring expertise, we have workout expertise, and we have that operational muscle to, one, prevent further distress in the businesses that we own and to improve the businesses that are already, operating pretty well. So I think with that, I just want folks to remember that, like that you don't need distress to deploy capital, but you'll obviously, depending on where you are in the market, you definitely want a call option on distress, meaning you want a GP or a manager who can take advantage of that distress opportunity when it does arise.
Great. Candace, thank you so much for taking the time today to enlighten our listeners on all things special situations.
Thank you. Thank you, everybody.